All right, everybody, welcome back to the partner rundown on the game plan. We got a lot to talk about today. Let's get right into it. So many professional athletes are becoming more active and more public as venture capital investors. Tim, what do these athletes need to know?
I think the narrative of the broke athlete scared a lot of athletes away from alternative investments, that combined with what their financial advisors were telling them. But the game has changed. Athletes are making more money than ever. They've got more talent around them in terms of how to protect and invest their money. So they can take an allocation, they can carve it out and say, hey, I want to do some interesting things here, maybe something with a little bit more risk like venture capital, which, by the way, is part of any sound portfolio strategy. So I think what we've learned from guys like Matthew Dellavedova, who's been on the podcast, Derek Morgan, the former Tennessee Titans linebacker, is to start small, because that's a great way to learn. What do I need to do to source deals? How does a deal investment work? What's my relationship like with the founder? What do I need to have set up from an admin, tax, accounting standpoint? So by starting small, you can start to get exposure in some of that and then really decide where you want to go, whether it's to continue to directly invest yourself or maybe work with a fund and be willing to pay a management fee.
I think the important thing to remember, Tim, is that when you get into an early stage venture capital deal, these things are commitments for 6 to 10 years as an investor. And we know that 65% of companies don't return the money that they initially take on, which means that even if you are going to see a return, it's going to be a long time, and most likely sometimes you're not even going to see a return. The other thing to remember that most investors do is that they focus on a couple of different areas. So if you are coming in as an athlete investor, maybe those focus areas are endemic to wellness, fitness, health, sports. Maybe they're not. Maybe you have interest in deep tech or some sort of frontier tech. All you have to do is spend time on that category and make sure that that's something that you become known for. Because at the end of the day, the one constant is that founders want to work with investors who are knowledgeable about the space that they claim to be knowledgeable in. So you want to make sure that you carve that out for yourself. And then at the end of the day, yeah, it should be part of a balanced portfolio. Nobody is putting 100% of their wealth into venture capital, nor should they be.
So similar to some of these athlete investors, I thought I was unique when I stood up my fund, TAC Ventures, in 2015. But now it seems like everybody and their brother is setting up a fund and becoming a VC. Jay, what exactly is going on, and help us understand what a rolling fund is?
So this rolling fund concept that was rolled out by AngelList recently, it has to be contrasted a bit to what we know to be traditional venture funds. So traditional venture funds, they take months, sometimes years to raise. They go to institutional LPs and family offices. And there's also restrictions on how much they can market publicly when they're going out to try to raise. Contrast that to a rolling fund where, because of some SEC regulation, folks can be more public about the fact that they're raising a fund. They also don't have to raise all of it up front. They raise it in quarterly tranches. So now LPs who maybe aren't sure about a manager can put a small check in up front and allow them some capital to get there. So AngelList's, whole ethos has been about transparency, and that's a really great way to give folks that maybe don't have the ecosystem power to go and raise a $50 million fund from institutional LPs, allow them to raise maybe a $1 or $2 million fund and get really active as investors early on. I do think the one challenge becomes is that the LPs have to keep re-upping on a quarterly basis. So if your LPs decide to walk away from you, you suddenly don't have the money to maybe make your portfolio strategy work.
Look, I'm all about the democratization of venture capital investing, especially as public markets provide fewer and fewer opportunities for investment. But what I struggle with is I'm not exactly sure a rolling fund is the best way to do it. It gives you all of the downsides of a traditional venture fund structure without the flexibility of, let's say, an SPV or special purpose vehicle. I understand the need maybe for a management fee so I can have some walk around cash in my pocket. But the beauty of a SPV is it doesn't have to be your only endeavor. You can go advise other companies. You can go have a job elsewhere. And it's also on a deal-by-deal basis. So as far as your LPs are concerned, they don't have to pay a management fee, and they can look at the merit of that deal. So if you're going to go to all of the trouble of constantly re-upping with your LPs again and again, whether it's on a quarterly basis like with a rolling fund or on a deal-by-deal basis like with an SPV, in my mind, you might as well just go the SPV route and stay more nimble for the long run.
Yeah, that's fair enough, Tim. But I remember there was a time when sports betting was an expletive in the halls of the NFL. Now every day we're hearing that a new pro team is signing sponsorships with casinos and sports betting companies. So what exactly changed?
Yeah, you're absolutely right. And the biggest thing that happened was in the summer of 2018 when the Supreme Court struck down PASPA, which enabled states to make sports betting legal. And I think it's something like 19 states now where sports betting is legal. It's different in each and every state. The really interesting thing about these marketing deals, and I'm calling them marketing deals between sports books or groups like DraftKings and different teams, leagues, stadiums, is they're not actually sports books. So if I am in the state of New York, I'm in New York City, I go to MSG and I go to the DraftKings lounge, that's not actually a place I can place a bet because sports betting in New York is not legal. So DraftKings has been doing this for years, even before PASPA was struck down. They wanted to create as much of a beachhead as possible, and it's really paid off. As you've seen, their stock price basically 5x this year with deals that they've announced with, I believe, ESPN as well. And so I think on the one hand, it's curious because I'm in a DraftKings space and I can't place a bet. But on the other hand, it makes a lot of sense because at the end of the day, they just want to funnel as many people to their app as possible, drive as much awareness as possible, and they see once that gate comes down, they become the default choice for sports betting in those states.
Yeah, the point you're making there is what I've actually always struggled with when it comes to daily fantasy or sports betting companies, is that effectively every single one of these becomes a race to the bottom on margin. They're commodities products, right? The moment somebody launches a new way to bet, the next company goes ahead and copies it, and suddenly you're back to parity. And so when you're a fan or you're a bettor, right, you're just looking for whoever's going to give you the best deal, whoever's going to give you the most money up front to go join their platform. That's why these folks are going and aligning with the teams, because they're hoping that through a marketing relationship, they're going to stand out in the eyes of the customer in some different way. The biggest problem, and this is just with my investor lens on, the biggest problem is that you have to create some sort of a customer loyalty or customer retention. Otherwise, you're going to keep spending to try to keep acquiring customers that theoretically should already be yours. And that's the challenge that I always have as an investor in one of these categories.
Okay, so I promised myself I wasn't going to bring this up, but in my mind, Jay, you are Mr. Celebrity Co-Investor. I noticed that Kanye released over 114 pages of the deal with his record label. What are we to make of this?
Well, I haven't read all of it, but the stuff that I have read is fascinating when it comes to the breakdown of his budgets and royalties with his record label. Look, Kanye is highlighting what I think is a massive shift in the world of content, with the power shifting from producers and distributors to the actual creators. And the reason that we had to have distributors and producers in the past was because production and distribution costs so much. But now when you can produce a really quality show on small budgets, I mean, look, in the movie world, we've seen this with Blumhouse where they hit home runs off of pictures that cost less than $5 million. We're seeing it in the podcast world when Call Her Daddy had their dispute with Barstool, and they realized that, look, they're the #1 podcast. Why do they need a studio again? And now we're starting to see that in the record label world where folks that are creating really quality content are figuring out that they're the ones that can actually create digital distribution, and they don't need to be paying 20% plus to somebody else to actually distribute their content. So more power to Kanye, man.
Yeah, I think it's great that he's shining a light on these studio contracts and just how binding they are, especially as it relates to the masters. You also have groups like United Masters, powered by Steve Stout and Ben Horowitz, which has raised $70 million and has created a platform for new musicians to come in, own their masters, but experience the full distribution engine of a stood-up label. What I think is really interesting is when you look at Spotify and say, well, why couldn't an artist just go direct and post their music on Spotify? They are really obliged to the labels as well because they need all of that content, all of that music, all those catalogs on their app. And without that, they're not as interesting of a platform for a listener. So what have they done? They've gone and they've focused on podcasts, right? They've gotten Joe Rogan. They went and got Bill Simmons from The Ringer, because with those guys, they don't necessarily need to own the catalogs or the content. They just want to expand their reach, expand their audience for Spotify. And those guys have big audiences and can bring them in a way that doesn't really disrupt or upset the labels.
Yeah, that's a great point, Tim. And, there are plenty of reasons that Kanye makes it hard to be a fan, but speaking up for the independent power of creators is definitely not one of them. So more power to him. We're going to keep tabs on that situation, and we'll make sure to talk about it again on The Rundown. Thank you so much for joining me this week.
Thanks, Jay.